And welcome once again to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. And online you can find Jay at retire210.com or 210-985-6200. Got a lot of questions as we look at some of the headlines out there, Jay. And over the past couple of years, you've heard the term the Mag 7. And actually, sometimes they've talked about how there's the 7 great stocks out there and 493 that aren't doing so well.
Right.
Well, you know what? That's starting to flip. Only 2 of the Mag 7 are now up, Alphabet and Amazon, and the other 5 are down. And those other 493 that we were talking about, they're actually doing much better. So they say the market is broadening out.
Yes.
And that's a good thing. So, Jay, I mean, of all the predictions and everything, and I know we talk about how much baloney that is, nobody really knows. But do you see good signs like that? Does that say good things for this year?
Well, I'll caveat with saying I'm not making an estimate on this year, because one of the things, we might talk about this later even, is, we did we brought in one of our economists from Boston for our 2026 economic outlook that we recorded. And, I started off by saying, hey, last year when we did the outlook for 25, what I said was, hey, this is going to be year 3 of an up market if we get it. And that is pretty uncommon in the history of things. Well, I started this one by saying, we're at year 4 of, and a 4th up market is even less common than what we had last year, right? So who knows what everything has in store for us. There's definitely some positive signs out there, right? With some of the metrics we see. But this is a big one.
Yeah.
Because what you're talking about here, the economic term for it, and it's a gauge that we monitor. It's one of the gauges we monitor for our investment committee, is market breadth. Is what you're calling that, right? So the S&P 500, well, surprise, surprise, there's 500 different stocks that make it up, right? That's why it's called that. And for a long time now, what you said is right. There's been a handful of them, Mag 7, and I'll probably forget them all, NVIDIA, Microsoft,
Apple,
Google, Apple,
Meta.
I don't know if I said Facebook. Yeah, Facebook.
NVIDIA.
Yeah. I think is Amazon. Maybe we said Amazon. Anyway, I knew I'd start repeating myself. Most people, the big household names you mentioned every day, they've been doing the heavy lifting.
Yeah.
They have, right? So if you look back in for 25 and you say, the market did, I don't know exactly what it closed at. I can't remember now. We've got it in the report somewhere, 15%, let's call it, right? Well, if you take out those 7 stock that we mentioned, it wasn't a 15% return.
Right.
They've been doing the heavy lifting, and it's not good, because it's not a good indicator of the economy when there's a handful doing the whole lifting and nobody else is coming along, right? We talk a lot about in this country, the 1%, right? Well, the 1% are doing great, but the rest of us aren't doing that well. Well, you want everyone to be doing well, right? It's a sign of a healthier economy. Similar sort of concept with this. So, we'll see, a couple of weeks does not a trend make, right, in this scenario, but we'll see, and hopefully it continues in this direction.
Well, one of the articles I read about AI is that all the low-hanging fruit, so to speak, for AI is done.
Yeah.
And so now they're at the point they're established, and now they have to start to show a profit. And a lot of these companies have not yet, and now it's all about building data centers and, building up these companies and making them profitable and all that goes along with that. So the easy work has been done. Now the hard work begins. So we may see some of this start to slow down just a little bit.
Right.
You're listening to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. Online, find Jay at retire210.com. Maybe you're a market watcher and you're really in touch with this kind of stuff, and you see this and some of this stuff concerns you and you wonder where to go. Well, this is great conversation for Jay to sit down and talk through all of that. Again, 210-985-6200. Okay, I don't want everybody to get a pencil and paper out, but I'm going to give you a 3-question quiz here. Everybody can play along. It's like a little game here that we're going to play. Greenwald Research did a survey, and they got some interesting results from people who are approaching retirement. So here you go. You can choose a $20,000 raise or a 4-day work week. 44% of people picked the 4-day work week. Yeah. You can choose never worry about money again or never worry about your health again. 60% of people chose health. You can choose. You get $1 million or 5 extra healthy years added onto your life. Almost 60% of people chose the health. So what we think retirement planning is all about math and money, what we really want is time and health to enjoy it. That puts a little bit of different spotlight on what you do, doesn't it?
Yeah, it does. And I don't know the details of this, but it wouldn't surprise me if this was asked to a bit of an older crowd. Right?
Yeah.
Because that's kind of what happens as you get a bit older. You decide, I have more money than time, and I need to find a way to use my money to create more time.
Yeah.
Right. And that's really what you want to do. And we see this a lot, and it factors into our retirement planning as well, because really when people come in, we're kind of walking them through the retirement planning process. And because we've seen it so many times, we know ultimately when someone comes in talking about balances and growth and asset allocations and stuff like that, that we're going to eventually end up walking them to the fact of, but what is all that for? Is it so you can enjoy your retirement, spend time with your grandkids? Yeah, okay, that's what really matters, right? Let's plan for that. Yeah, the other stuff's important, right? We need to organize that. But in the end, it's about achieving this goal, right? Spending time with your grandkids, traveling, whatever it might be, right?
Yep.
And that's when it starts to come into, okay, how is my retirement really going to look? Is it going to be this linear thing where I'm taking out $7,000 a month for the rest of my life, and I just need to see if I can make that out to 90 or 95? That's a very simple way of looking at it, and that's what a lot of basic planning tools will teach you. But this is really how you're going to experience it, or how you want to experience it. Are you going to travel more and be more active with your grandkids when you're 65 or when you're 75? Probably 65, right? Are you wanting to create more memories when you're more active and you've got more energy, or when you need to take a nap at 2 p.m? Probably when you're younger, right? So is it really going to be I'm taking out X amount of dollars for the rest of my life? Or is it going to be, hey, the first 10 years, we've got a list of items we want to get knocked off, fun things we've always wanted to do, and we need more money for that. Okay, let's create a stair-step approach, right? Let's look at spending more early on, ratcheting that back down. It doesn't mean you don't have a great retirement. It means you've been able to use your money to create the memories and have the best use of your time.
Yeah, I heard a phrase the other day. Somebody said the phrase memory dividends. And they, you're all worried about dividends in your investment. What about memory dividends? When you're in your 80s, are you going to be sitting in a chair and looking at your Fidelity statements and being all proud of that? Or are you going to be looking through your phone and your iPad and looking at all those pictures of your kids, your grandkids, the vacations, all that? That's really what this is about. And I love what you said. What is all this for? 40 years worth of work. What is all this for?
Well, look, this is the best personal example I can give, right? And anyone could take this and they will be able to align this with something they've done. We put a little playground in the backyard for the girls, right? I've got 3 girls, and in the backyard for the girls. And my wife, she wasn't against it. She wasn't for it. She was just like, yeah, well, whatever. If you want to do it, go ahead and do it. And I went and did it. And it's got, the slides and the swings and the playhouse thing that they hang out in. And very often we're out there for 20, 30 minutes in the afternoon. And now she's like, this was a great idea. I'm glad you did it. And I said, yeah, this was a selfish thing. I'm glad that they're enjoying it, but it was really for us. Right? And it's watching them play on it. Yeah. It's being on the swings. That's what you were talking about. It's that when, hopefully I can still freaking remember it when I'm 80, right? Yeah. But that's the thing is like, when you're older, like where's a place you're going to go to mentally that keeps you warm? And it's those things, right? That's what I think.
And that is retirement planning. And that is, in many ways, Jay's got this great job that he helps you find that place. Right. And that's what we want to do for you. Give Jay a call. Talk to the team at Secure Financial Management. Get a meeting on the calendar, and let's start to talk through this. Retire210.com is the website. Tool around there. Find out more about Jay and the team. Give them a call. Get a date on a calendar. 210-985-6200. 210-985-6200. All right, so one of the things about going into your 60s and 70s is the kids are out of the house, and it's very common for people near retirement to downsize, get to a smaller house. I don't need 4 bedrooms and 3 bathrooms anymore. That's very, very common. But what's happening right now is people are looking at the price of going into that house, and they're going, I want to downsize my house, but I don't want to upsize my mortgage.
Right.
And so there's that going on right now. So people are many times just retiring in place. They're saying, I'm just going to stay in the house that I've been in for the last 30 years. And when you don't do anything, you don't think you have to do anything else. The other one is boomers are so afraid of running out of money. The attitude is, I'll just spend everything that I have, and if there's something left over, I don't see that there's a real need for an estate plan. That's pretty easy. So, Jay, sometimes people get comfortable when everything's going along fine. They don't plan for the future, but things can come up and bite you. Talk to me a little bit about estate planning and how you help people get into that conversation. And sometimes you got to poke them a little bit to get that thing going, don't you?
Yeah, well, it's part of the process with our financial planning is looking at the estate planning side. Is there a desire to leave a legacy, leave an estate? And I'll circle back to that because you touched on something that is 99% of the thought process people have on that, right? So I'll come back to it.
Okay.
But I want to talk about the whole downsizing, retiring in place sort of thing. You couldn't be more spot on. And the problem is, and we've talked about this in other shows, the cost of everything is just so bananas right now that if people downsize, everything is so, and a lot of people, they've been in these houses 20, 30 years, right? They've been there forever. And they paid $250,000 for a house that's now worth $1 million something, right?
Yeah.
And I had an appointment, a review with a couple about a month ago on this exact topic. And they said, well, we kind of want to look at our plan and see, if we downsize, if we change things up a little bit, what does that look like? And we never even got into that because the whole meeting was spent discussing how they don't think that they can really do it anyway. Because they say, we have a certain style of life that we like to live in. Like we like certain, appliances, finishing, like whatever it is with their house. And they said, if we sell our house, not only are we going to have less square feet, which isn't really a problem, right? Because that's what they're doing it for, 1 story, et cetera, things like that. It's the quality is going to be nowhere near what we're used to. And they say if we can sell our house for $1 million, if we go laterally and we don't spend more money, we're taking a cut not just in size but in quality, and we don't know what to do.
And
the house is a bit too much for us. It's got acreage, so we don't want to do that, maintaining that in retirement. But then we also don't want to cut our quality of life either.
And one of the reasons people would downsize is they take that house that they paid $150,000 for that's now worth $750,000, and they would use that equity and they would use that money in retirement. But now you have to spend $1 million to get into another house, and now you're behind and you've got a mortgage where you didn't have a mortgage before.
That's exactly right. And
gosh,
I'm trying to think. Last year, I probably had 15 or 20 of these conversations with different couples that we have as clients. Only one of them actually went through with it, and he's
interesting,
very financially comfortable. So the money was not really that much of an issue for them. But only one of them actually pulled the trigger because, interest rates aren't helping out, obviously. Right, as well. That's not helping out. But even still, interest rates are coming down a little bit, and they're probably never going to get back to the 2.5%, 3%, that everyone remembers from 5 or 6 years ago. Even still, even if you can finance it for not that much, just at least for me mentally, it's why would I give up this beautiful house I have that I've remodeled and I've got it exactly how I want to go into something that costs just as much or more for less space, and it's not set up the way I want. It's pretty funny.
My wife
funny,
uses the term
ironic, I would say.
Builder grade. She says, you can go to a house that costs $1 million and the faucets and everything, it's just kind of cheap. And she goes, we'd be replacing all that stuff anyway. Yeah. And she's a big one for that. She goes like, I don't want silver doorknobs. I want gold doorknobs. So now I got to buy 23 doorknobs. I don't like the plates that go around the sockets. I don't want them to be silver. I want them to be gold. And I'm like, oh God. The pulls on the cabinets. I got to buy 50 of those things.
That's right. But before you know it, you're spending, an extra $20,000, $30,000 and getting very little for it.
Yeah,
right.
Exactly right.
But circling right back to the estate planning side of it, there's still a need for estate planning.
Yeah,
there still is, and this is the way I would present it to anybody listening, because this is how I present it in the office as well, is you're not doing the estate planning for you necessarily. Mm-hmm. You're doing it for your heirs or your kids or whoever's getting what's left, right? That's who you're doing it for, because the process is going to have to be resolved one way or the other. Mm-hmm. Yeah. Once you move on to whatever you believe is next after we leave this world, the people left behind are going to have to resolve this one way or the other. Mm-hmm. Do you want to make it easy for them, or do you want to make it more difficult? Right. That's the thing. Secondly, if you do have assets that are going to be left, and we're kind of getting back to the point now of, I don't want to run out of money, so I'm going to use it all, but then I'm not going to spend it because I don't know how long I'm going to live. There's likely going to be assets left, whether that's the plan or not. Right. Even if there's not a ton of cash, like you've got your property, whatever that's worth, there's going to be something there. Make it easier for those people that you're leaving it to. And secondly, don't you want to have some sort of say in what happens to your assets, right? You probably have certain people you want it to go to and certain people you don't want it to go to. Yeah. So if you want to have your wishes followed, leaving it unattended to means that you don't know where it's going to end up.
It is a part of retirement planning. We're eventually going to get around to that conversation. I like to call it, dominoes. First, we're going to talk about investments, and then you're going to ask about taxes, and then you're going to ask about Social Security. It's just one after another. And eventually we're going to get to, okay, if I leave this world, where is this all going to go and who's going to get it? And that's a conversation that you should have, even if you're going to stay in your house forever, even if you feel as though you don't have a lot to pass on. This is part of the conversation. Let's have it. It is retire210.com. That's the website to get in touch with Jay and the team at Secure Financial Management, retire210.com, or give them a call, 210-985-6200, 210-985-6200. There's a few rules of thumb that we've kind of blown up along the way here in various shows. We talked about the 60-40 portfolio, and we've talked about all these crazy numbers that people want to have as far as what they need for retirement. Another one is something called the 4% rule, and I'll just run by it very quickly here. If you take 4% of your money out, you've saved $1 million. We'll say 4%. That's $40,000 a year. If the market's moving up, you will probably be just fine throughout your retirement. Well, maybe not. This guy in MSN said, I used the 4% rule and I ran out of money in 10 years. So he says, basically, if the market goes down, your 4% pull becomes bigger. The market's falling, you're selling assets at a loss. There's a lot of problems here. So, Jay, do you have people that come in and think they're going to follow this rule, and do you have to dissuade them from it? Or is this something that it's easy to say this just doesn't work?
This is the sort of thing that's great for a newspaper article. Okay. Or a blog post.
But right? Not in practice.
And then you put it into reality. And, the problem comes with a lot of the time when they start to use the word average. Mm-hmm. So the market averages 8% over time. Well, the key in that phrase there is average, right? Because if it was a linear 8%, just checked 8% every year, wouldn't that be wonderful?
Yeah.
Right? It would be easy. And the 4% rule wouldn't be that bad then. Like you could probably live off. That's not the way the real world works. And let's talk an example of averages, right? So, Randy, if you, me, and 10 other people were in a room, so it's you and me, and we've got 7 other guys that work colleagues, friends, whatever. All right? So now we've got 9 people. Mm-hmm. And what we're going to be looking at is what is the average income or net worth of these people. Now, we're one person short. Let's drop Jeff Bezos in there. Or let's drop Bill Gates in there. Or let's drop Elon Musk in there as that one final person.
The average just went up in the room, yeah.
We're all billionaires.
Yeah.
We're all the average net worth of that room. is $30-40 billion or something, whatever it is, maybe higher. I'm not doing the math that quick. I'm a long way from that in reality. So are you, I think. And the 9 other guys that are there with us, none of us are even close to that. But the average is that we're all multiple billionaires. And it couldn't be further from the truth.
Right.
Yeah, the way you get that average 8% return is you got some knockout years where you're doing 15, 20, 25%. And then you got some 2008s in there.
Yep.
And you got some 2000s, some 2001s, and some 2002s. It'd be interesting to know when this guy retired. If he retired, and we're getting technical here with this, and we don't need to go too far down this rabbit hole. His issue, it sounds like, was what we call sequence of return risks. In the investment world. And what that is if you take 2 starting balances and you put 2 different experiences of what the market actually does, the end result is very different.
Yep.
Because if you retire into a down market, maybe this guy retired December of 21 or the first week of January of 22. And 22 was an ugly year. Didn't matter if you were in bonds, didn't matter if you were in the stock market. It was an ugly year. And he's pulling his 4%. And now he's also having to sell into a down market. And things are going south very quickly for him. The worst example of this, or the clearest example is what I should say of this that I can give, is somebody who retired at the beginning of the millennium, 2000. You retired in 2000, you're riding a bit of a high. Like the 90s were just incredible for the stock market. And then you retire and the market's down, and the market's down, and the market's down.
Yep.
And then you get a couple of reprieves, right? I think 2003, 2004, 2005, something like that. We get 3 or 4 years. And then boom, you get hit again, 2008. And we're down 50%. That person who relied on the strict 4% rule and they didn't have other things lined up to hedge against this possibility, they're either living off Social Security or they're back at work.
Right.
Because they probably don't have any money left. Yeah.
And these are the things that we can't see coming. And, we don't know what the market's going to do. So in order to have a hedge against that and to say, I'm not going to have my retirement be dependent on a stock market is a very good start to a conversation. And we would love to have that conversation with you. If that's what's really got you spooked, is you say, I don't know what that market's going to do, and it just scares me to death. And I lived through 2000. I lived through 2008. I don't want this to happen again. Okay, let's build your retirement plan that way. Give Jay a call. Give us a look on the website. Very simply, retire210.com. Retire210.com for secure financial management. You can also give the team a call at 210-985-6200. 210-985-6200. Let's sit down today and work through the details of your retirement. And remember to have this podcast delivered straight to your favorite podcast platform by hitting like, follow, or the subscribe button. Thanks again for listening to Clear Skies Retirement, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jamin J. Kirkwood, Texas Insurance License number 1421850.